Welcome to Module 2, the case for Bitcoin. In this module, we'll look at why the old Treasury options, cash, bonds, and even equities aren't protecting purchasing power anymore, and why forward-looking treasurers are turning to Bitcoin. With its fixed supply, neutrality, and resilience, Bitcoin represents a fundamentally different kind of reserve asset. Let's dive into why this shift is happening now, and what makes Bitcoin uniquely suited to today's economic environment. Cash, bonds, and even equities, assets that were once trusted to store value over the long term, are no longer getting the job done. This puts corporations and nation-states in a bind. The challenge isn't just preserving capital, it's about threading the needle, maintaining liquidity, and protecting long-term purchasing power without triggering regulatory reclassification or adding unnecessary risk. The old Treasury playbook, that is, sit on cash and short-duration bonds, is no longer working. But many alternatives bring problems of their own: volatility, complexity, or strategic misalignment. And yet, doing nothing is still a choice, one that quietly erodes the value of the balance sheet year after year. When corporations accumulate retained earnings, they have a few options for what to do with them. They can issue dividends, which reward shareholders directly, but decapitalizes their business in the process. They can buy back shares, which signals confidence but reduces reserves. They can pursue M&A, but this often leads to long ROI timelines and integration risk. They can reinvest internally, but that comes with the risk of overinvestment, especially in uncertain conditions. Or they can save money and build up their balance sheet. But even that comes with a cost. Saving in cash today suffers from what Michael Saylor calls the melting ice cube problem. As the cash sits there, inflation melts away its value in real terms. The question becomes, what will your balance sheet actually be able to buy in 5 years or 10? That dynamic is why both corporations and governments are now searching for something new in their strategy. It's not a way to juice yield, but a way to preserve purchasing power while reducing risk. And increasingly, the answer forward-looking treasurers are converging on is Bitcoin. Why? Because Bitcoin is an asset built for this environment. It doesn't rely on the credit of any issuer. It doesn't represent someone else's liability. It's not governed by any central bank or government. In other words, Bitcoin is a neutral reserve asset with no counterparty risk. And crucially, Bitcoin's supply cannot be manipulated or inflated. There will only ever be 21 million. That number is programmed and hard-coded. No central bank can dilute Bitcoin, no corporation can override it, and no government can change it. We know exactly how many Bitcoin exists today, tomorrow, 3 years from now, and even 100 years from now. The mathematical certainty around Bitcoin's fixed supply is what makes it scarce and protects holders from inflation. Compare that to fiat currencies and things couldn't be more different. Since the supplies of fiat currencies are controlled by humans instead of code, there's no way of knowing how many dollars will be in circulation tomorrow, let alone a century from now. Take this chart of the M2 money supply. Did anyone entering 2020 expect the money supply to increase by nearly 40% that year alone? No, but that's precisely what happened. Trillions of dollars flooded the system, prices rose, and the purchasing power of those dollars fell. Even as central banks now attempt to rein things in, structural forces like high debt loads, aging populations, and rising geopolitical friction continue to push inflationary pressure higher. That's where Bitcoin comes in. It offers corporations a scarce, neutral, globally traded, highly liquid asset. And today, even a small allocation offers asymmetric upside. That's a rare combination of protection and potential. What makes Bitcoin so compelling as a reserve asset is that it provides a hedge against currency debasement and geopolitical uncertainty, while also having the potential to drive long-term returns. Treasurers are beginning to view Bitcoin as a unique asset with the safe haven properties of gold and the growth potential of a tech stock. This logic applies not only to corporations, but also to sovereign treasuries. In fact, for governments, the stakes are even higher. Historically, central banks have relied on dollars, euros, and developed market sovereign bonds to anchor their reserves. These instruments are liquid, they're familiar, and historically safe, but what they are not is neutral. In a world of rising geopolitical tension and trade wars, owning another country's debt or currency isn't as safe as it used to be. As discussed in Module 1, the freezing of Russian central bank assets in 2022 was a seismic event. It reminded the world that the reserve assets held in another country's system are not truly sovereign. They can be seized at will. Since then, the World Gold Council reports that more than 70% of central banks globally have indicated they're reassessing their reserve composition. The response is central banks have been buying record amounts of gold. Since 2022, their annual gold purchases have more than doubled. And what have these global banks been selling to buy all this gold? That's right, dollars. This trend makes one thing clear. Central banks are diversifying into assets that can't be printed, frozen, or politicized. The world is recognizing the benefits of holding neutral reserve assets, ones that reduce the risk of censorship, confiscation, and inflation. After years of record buying, gold now makes up 20% of global central bank reserves, second only to the dollar. As these charts highlight, the capital rotation into neutral reserve assets is already well underway, and it reflects a broader truth. In an era of financial weaponization, inflation, and fragmentation, institutions are searching for stability outside the system. That's why gold demand is soaring, and that's why Bitcoin is becoming more popular with treasurers by the day. In a world where other reserve assets are becoming less attractive, allocating to Bitcoin is now no longer contrarian, it's prudent. This concludes Module 2. We've seen why Bitcoin stands out as a scarce, neutral, globally traded asset. In Module 3, we'll put that theory into practice, comparing Bitcoin side by side with every other major treasury asset class.